Accounting can be fun. Okay, so one of the main people that I watch all the time is Marcus Lemonis of The Prophet, and I just felt that some of the things that he talks about a lot in his show is how he looks at the revenue numbers and why the books are so important. He says that if you don't have accounting, you don't have a business. And I tend to 100% agree. It separates the pros from the amateurs, and for those people who are doing real estate full-time to those people who are just doing it as a side hustle. So here's the thing. Accounting does not need to be scary. It doesn't need to be complicated, and that's what I want to dispel for you right now. So I want to talk to you very quickly about something called an income statement or a P&L. Or basically P&L is also profit and loss. It's basically all the same thing. It's all basically tracking revenues, money coming in, and expenses, money going out. And that's all it is. So if you look here on the screen, you're going to look here at your revenues. And again, I just kind of broke out these categories, and it's just some general basic things that you might see for a rental property. I would rather you break things out in terms of revenues rather than lump it all together. Meaning, if you get rents and late fees and application fees and you just kind of all throw it into one account, I would rather know where that money is coming in. I would always break it out. When in doubt, break it out. I always like to know what the individual line items are rather than not. And generally, my accountant does too. The reason being is because back when I was first doing this, I just got started and I didn't realize how much rent revenue was coming in versus how much late fee revenue was coming in. And my late fee revenue was substantial. And I didn't realize how much even money I was leaving on the table by not consistently charging late fees. So that's something that we definitely want to make sure that you're tracking and you are keeping an eye on. Okay, so what I want to do, you can do an income statement or a P&L for basically any period of time. Generally, it's either done on an annual or basically a monthly, quarterly, or annual basis. We're going to do this basically on a monthly basis. So we're just going to pretend that this is what we had coming in for last month. Now, I'm going to add something in here real fast. I'm seeing that there's I don't know why it didn't save, but all right, we're going to put in a column right there. Okay. So this is everything that we've got right here. So if you look at the income statement that's coming in, so you've got rents, and we're going to say that we've got $1,000 in rents that came in for last month. We had $50 in late fees. We didn't have any application fees because we have one property. It's already been rented. We do have pet fees coming in of $50 a month. There is no coin-operated laundry. This is a single-family dwelling, but you know what? We do rent them. They're washer and dryer for $50 a month. There's no storage fees, and then utility fees. That might be a fee that you would charge somebody if they left the utilities in your name and continued to live there at the property, or for some reason the property, the utilities kick back into your name. Sometimes that happens for non-payment, but what I would suggest is do not offer that as a service where you're doing this, where you're paying their utilities. Generally, it's been my experience that if the utilities wind up in your name, it's not much longer that they start having trouble paying the rents as well. So I do make the utility fees quite stiff, and we'll just say that's an extra $100. All right, so taxes. What I'm talking about here, when we go into the expense side, this is all the money that's going out. So our taxes, our tax bill, let's say, is $100 a month. Keep in mind, if you were underwriting this property, meaning this is a property that you didn't currently live in, but you were thinking about buying it and you're going through this income statement analysis, this cash flow analysis, if it was a property that you didn't that was not currently a rental property but was owner occupied, the amount of the tax bill will be different if someone's living in it versus that owns it versus someone who's living in it that's renting it. Okay, so just make sure that you understand that before you hang your hat on a tax calculation, because the differences can be substantial. The amount of the insurance, I'm actually paying $50 a month. Now, this is something, again, you can get the actual number from the person or from the company that's providing you your insurance. Water bill, again, we let's just say for argument's sake that they did put all the water, sewer, trash, electric, and gas in their name. If I was underwriting this property, though, I would still make an allocation for this, even if the residents are responsible for their utilities in their own name. And the reason being is because you need to budget for expected periods of vacancy. And expected periods of vacancy, you're going to have to cover the utilities in your name. Even if they're minimal, you're still going to have to pay for water, you're still going to have to pay for electric, and you're still going to have to pay for, lawn care, right? So let's just pretend in this case that there was no utilities in this particular instance, but they did neglect to take care of the lawn. So we'll say that the lawn was $125. Because it got like waist high, and that's when I would charge the utility fee of $100. We can call it that. All right. So what in this particular case, I would go back up here and saying HOA dues. The HOA dues, let's say there's no homeowners association or condo association that you have to pay for. If they were responsible for that. So sometimes what will happen is if there is a homeowners association, if the lawn doesn't get mowed, they'll mow it and then they'll charge you. And that's why I say it would be appropriate for there to be a utility fee or some sort of ancillary fee that needs to get charged because you have to take care of this bill that came to you. All right. That's why I say I just stuck that on lawn care. Okay. So snow removal, let's say it's in the middle of July. There's no snow except, of course, you people up in Wisconsin. Vacancy expense. This isn't an expense that you would normally expect to see on an income statement, except maybe if you were doing a cash flow pro forma or analysis on a property that you would want to buy. Now, let's talk about this real fast. In vacancy expense, what many people will do is they'll say, well, my vacancy is about 10%. And with really no understanding of what that number even represents. If you're thinking, okay, so it's going to be 10% of a year that my property is going to be vacant, okay, that means my property is going to be vacant 1.2 months out of the year, which would be a little over 5 weeks. So if you're thinking, okay, my property is going to be vacated the last day of the month, and I'm not going to have it rented, re-rented, or ready and re-rented to someone else generating revenue for another 5-ish weeks, then that 10% might be appropriate. Here, in my market, renting single-family dwellings, usually we have people sometimes moving out the back door while someone else is moving in the front door, and we're trying to paint and clean in between. 10% would be a really long period of time. But apartments may be longer, right? That's just the nature of apartments. But single-family dwellings do tend to rent much, much faster. So maybe 5% would be a normal vacancy expense there. But I just want you to make sure that you know what you're putting down, and that it's actually representative of what actually happened. Advertising would be, again, if the property was vacant. But sometimes you may just want to run a continual ad, or if you have expected vacancy coming up and you want to get ahead of it and you want to run advertising, that advertising expense would go there. A leasing expense, that would be something where you are paying someone else possibly to show the property and then pay that leasing fee as an amount for getting the property leased up, basically paying for a signed lease. So if someone gets a signed lease, I would have to pay, say, half a month's rent or whatever you could negotiate for getting the signed lease for a leasing fee. Lots of property management companies do charge a lease up fee. So you may want to also calculate that in the amount of the property management fee. The property management will say it's 10%, but again, if you're paying yourself, that's fine, but understand that is also an amount that you should allocate towards property management if you're going to be doing the underwriting of the property. In this case, you are managing the property yourself, so there's nothing there. Repairs, let's say we did have $125 worth of repairs that we had to do last month. Say it was, it was a small plumbing fix that we had to do. And then we've got the mortgage payment, and this is going to be principal and interest only. And the reason why I would want the principal and interest only there is because we've already calculated the taxes and insurance up top, right? And in that particular case, we'll say that the total amount of the principal and interest only is say $675 a month. And CapEx. So this is where generally most people run into problems, and they generally do not budget near enough for capital expenditure on the property. CapEx are the things like, the big ticket items that you're going to have to pay for. So like a new driveway, a new roof, a new furnace, right? These are big ticket items that generally they wear out over time. There's no getting around it. You're going to have to replace them at some point. And these are things where you have maybe $6,000-$8,000, for a new furnace. or maybe, $20,000 for a roof. You don't want to be surprised by something like that. So you generally want to make sure that you're allocating enough money, setting that enough money aside for capital expenditures. So let's say, and again, back of the napkin math, we'll say it's $115. Okay. So that means that you've got a net income of $60 a month after all of your expenses and your allocations for capital expenditures. That's basically it. Now that seems like it's a pretty lean amount. Maybe, you bought this property fully, maybe it's under leased, maybe it's, there's not a lot of rents coming in or whatever, but I don't want to get into that right now. I just want to make sure that you understand the basics of the money that's coming in and the money that's going out, and what's left over is also called the net income. Now, let's just say for argument's sake that we're going to bump up our capital expenditures to say $200. That brackets, anytime you have a bracket around a number, that would mean it's a negative number, and that would be a loss. So from an accounting perspective, that's what that would mean. So we'll move this back to 115, and there you go. So that's the basics, right? I told you it wasn't all that complex. It really wasn't all that difficult. My name is Mark Dolfini, Landlord Coach. If you've got any questions, reach out to me on Facebook, or you can make a comment down here on YouTube. Remember to always place a value on your free time, because if you don't, someone else will. Have a great rest of your day.